Hey guys, welcome to this video. I did a stream this morning. If you didn't catch it, go on my profile. I ran down all pairs pre-fed. Also, if you're interested in trading correctly, go under this video. My free training's there to change your perspective. So what I've got here currently is the pound dollar on your left, in the centre the pound CAD, and on the right-hand side the pound New Zealand. Now there's a good reason why I've done that. As you can probably tell from my accent, I'm English, I'm British, I live East Suffolk in England. Okay, in the UK, and I know the economy is a bit dodgy here. You did actually just have Goldman Sachs reaffirm their view on the FTSE, okay, the UK stock market. I think their target is going to be nearer 8,000, about 7,900. So I'm trading that a lot. But you had inflation this morning. You had UK CPI year on year end up at 6.7%, with the forecast at 7% and previous 6.8%. So inflation has actually dropped. And you can see accordingly, the pounds have started to fall. In other words, people don't want the pound as much to the long side, so they get short and it drags right down. Now that's great for people like myself, price action technical traders, because we're looking for those points where we can start to scale into the market. We do it at levels where there is clearly likely to be impetus, or it's probable you may get a rebound. Now, price action is all about looking for rejections in the market. It's all about looking for rebounds. It's all about looking at candles and saying, okay, well, what does that mean behind the scenes? What is that actually telling me, and what could happen? Now, we're coming to one of those points across the board on your pound, and the reason why is because on the pound dollar, you've come down almost in a straight line, since mid-July, pound CAD since August, the end of August, about a month ago, and pound New Zealand also August, about a month ago. Now, I called all of them short across the board before they fell. We caught that amazingly. It came right up on higher time frames. We looked for price action areas, and you had that big slam down. But after the red, as you'll know, and as you only need eyes to tell, comes green. Okay, and you can see across the board, that is exactly what history has done in the past. So saying it won't happen again is lunacy. It's just about where you do it. Now, you can tell from my moving averages, if you don't know me, I use moving averages on every single chart. Like I said, I'm a tech trader, mostly with technical analysis and sentiment feeding in behind that to move markets overall. But the closer you get to those higher moving averages, especially on higher time frames, the more likely it is generally that you're going to be getting a better value on your trade, because the moving averages act for a gauge for price, and obviously they catch up with price eventually. It's inevitable, they always do, and you can't really escape that. Or in 99% of cases, that's what happens. So on your pound dollar, you've come under your 200 MA, okay, big fall. On your pound CAD, you're coming towards your 200 MA. And on your pound New Zealand, on your weekly, this is on all charts, you're still quite far off it, but you are on your earliest MA. Okay, pound CAD being under 100 MA. So every single pound chart that I've got up, all three of them, and you would have pound AUD on here as well, not so much pound yen, but pound AUD. And more or less, what you're looking for is a place to scale in, because you're coming to those key moving averages and you've had that enormous load of red. So your job really is to say, okay, well, where would I like to do that? Now, getting into risk management is a whole other thing that I teach in my academy. So I'm only going to go over the technical part here. But you can see across the board, if you just zoom out slightly on your pounds, that what you've got is key areas of support, looking at candle wicks and areas where it's probable you'll get rejection. Across the board, you have got various levels just under where price is now. So I wouldn't be shocked, really, if across the board you do indeed end up falling to these levels. Okay, and that would be your long zone for a bounce. Now, even better would be if the Fed news comes out, dips down with a nice wick, people short a bit more, and then you get that impulse reaction. We all know with volatile news events, there's a good chance that you will get volatile price reaction, or in other words, impulse to the opposite side. So you dip to where you want your long, so you set your orders at price action levels. Orders get filled because the chance of rejection there is higher. It's more probable that will occur. And then when it finally does, of course, you would catch the impulse. But you've got to do that in the right size, and you've got to measure it within the trend. Because if you do zoom out slightly, if you pulled a fib from your previous low 103, for example, on the pound dollar to 131, you'd notice we've only come down to 123 from 131. So it's not an enormous way, about a third. So You've got to think about that within your risk, especially given the pounds have dripped down for a long time if you zoom out a long way. So you might see that continue over time. But nonetheless, I like to catch longs in between that. In downtrends over time, if it's a really, really long downtrend, you will find that, of course, you do get those long entries, and it gives you a chance to trade the market to the long side before you re-short higher up as you get back to those market value places over your MAs. Thanks for watching, guys. Hope that helps. Get my free training underneath. As always, I'll see you in the next one. See you there.